Okay, good evening everyone. My name is Muhammad and I'm Muhammad EX03258 and Liyana.
Okay. My name is Liyana Binti Yumahat. My matric number is EX03428.
My name is Megha, EX03470.
Okay. Good. We are group members that will discuss about case on PCAOB website between PricewaterhouseCoopers and KPMG. First, PwC. PwC was charged a civil money penalty, 100,000 for violated independence rules. PwC, from the case that happened is PwC was penalty of 100,000 is imposed on the firm. Violated auditor independent requirement, which involved the violated auditor independent requirements. PwC had personal financial relationship with client bank during the engagement period. PwC violates rules related to audit committee communications. They also failed to describe in writing pertaining to the personal financial relationships, which is non-compliance with quality control standards. PwC did not establish policies and procedures for accounting and auditing practices, especially relating to independence. This failed in monitoring the design and application of policies and procedures. This can be seen through the 3 of the 6 partners were in debtor creditor relationship with client bank. Each of them obtained or get a margin loan or mortgage for a second residence from client. The other 3 partners had uninsured asset in brokerage accounts with client bank or an affiliate. We also there is the second case is KPMG to pay 8.2 million to settle charges over auditor independence. Through the second cases, KPMG violated auditor independence rules. They also provided other auditing and assurance services such as bookkeeping. KPMG provided corporate finance services to affiliate of its client companies. There had been penalty of 8.2 million. Violations occurred at various times from 2007 until 2011, around 5 years. KPMG had to educate firm personnel and monitor compliance with auditor independence requirements for non-audit services. KPMG will employ an independent consultant to evaluate and implement the changes. Okay, the comparison will be discussed by our member. Next member.
Okay, I will discuss about comparison between both cases, PricewaterhouseCoopers SC and KPMG SC. Comparison between both cases, both PricewaterhouseCoopers and KPMG have violated independence rules. The difference is that PricewaterhouseCoopers had personal financial relationships with its client, but KPMG is not independent in terms of providing non-audit assistance and also corporate finance services. According to ISQC 1, relevant ethical requirements for quality control includes independence. An audit firm should establish policies and procedures regarding independence and maintain it. PricewaterhouseCoopers lack in this.
Next.
Independence requirement should be communicated to its personnel. This is what KPMG is required to do to settle its charges to Securities Exchange Commission. Policies and procedures shall include requirements for communicating independence breaches. This measure would be necessary for PwC. According to MIA bylaws on professional ethics, it highlights application of the conceptual framework approach to independence. Loan to a firm from an audit client that is a bank or similar institution may create a threat to independence like happened in PwC. If the loan or guarantee is not made under normal lending procedures, terms and conditions, a self-interest threat would be created that would be so significant that no safeguards could reduce the threat to an acceptable level. Provision of non-assurance services to audit clients create threats to the independence of the firm, which happened in KPMG. The threats created are most often self-review, self-interest, and advocacy threats.
Okay. Next is implication, which is the implication of what happened if these cases happen to the in our country. Okay, next. Okay, there are five implications, which is audit firm, in audit firm, in profession, in regulators, in shareholders, and public. Okay, first of all is in audit firm, what is the implication if this cases happen? Okay, the audit firm, the perception may be damaging to the audit firm itself as an actual independent valuation. Okay, the second one is the audit firm will lose the revenue, lost opportunities to cross-sell non-audit services, and potentially devastating legal liability. Okay, the implication to the profession as an auditor, okay, it will damage reputation, lose the ability to decide for themselves how their businesses should expand and what engagement are appropriate. Okay, it also the potential loss of the privilege of self-regulation that should concern and motivate accounting professionals as they consider whether perception of independence are impaired. Okay, the implication to the regulators, which is result in further government intervention and externally impose a new standard. Okay, next. The implication to the shareholder. Okay, the shareholder will demand higher return to compensate for possibly unreliable financial information. Okay, and the last one is the implication to the public at large. Okay, public will loss of confidence in accounting professionals' conduct. The second one is the public may believe a firm is not fully independent, even when that is not the case. And it will hurt the financial market because loss of integrity in auditor independence will mean increased cost of capital of all users. Okay. Next is the front page of cases, which is the PwC and the KPMG their cases lah. Okay. Next. Okay, only that's all. Thank you from all of us.